On today's show, 3 questions. Number 1, what's up with all this drama? Number 2, another one bites the dust. And number 3, how much can you contribute to a retirement account in 2026? Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Just us two, Rabih. Just
What's
us two
up?
on this Friday. We're going to hit this first. Rabih, thank you for the reminder. We've been meaning to do this, but call to action first is is what the Michelle has been pushing us to do. And I am a slow learner and have a hard time taking instructions, apparently. But here we are. We want to, right off the bat, talk about something we're super excited about, a new project that is coming together really well, the Dentist Money Launchpad. The whole point of it is everything, teach you everything you didn't learn about money in dental school. So it's going to be about around 12 weeks. We're not totally sure yet. It might be 14 weeks, probably. We don't know. We just have a lot of content, but it'll be around 12 weeks, live courses taught by a combination of our team and then also outside experts. So I was just texting with Dr. Daniel Crosby. We did confirm him this week. I told him, I voluntold him that he was doing it. And I told him, I said, hey, listen, man, I've already told everyone you're doing it. So I hope you, I hope you say yes. And he's such a good guy. We talked about it and he's agreed. So he is official that he's going to come on. Carl Richards as well. There's going to be a ton of content here talking about everything from, and we got Rabih, of course. Rabih teaching
I'm not
about
forced to do it, though. I'd love to do it.
Yeah, we've voluntold you as well. So talking cash flow, talking about investing, talking about debt management. Dr. Tony Shigtans is going to be part of the course as well, talking about finding the right associateship and how to navigate contracts. So there's going to be so much good stuff. If you're interested, if you are a dental student listening, or you are a new grad and you're wanting to build a better foundation around mastering your money, this is going to be a great course for you. It's coming out in early 2026. Early, I don't know what early means, Rabih. Early 2026. If you want to know more, go to dentistadvisors.com/launchpad and you can join the waitlist. Okay, Rabih, how was that? Was that okay?
Perfect. Yeah, thanks everyone for listening. I'll see you next week.
Yeah, okay, that's it. All right, guys, that was our 2 cents. Congrats, thank you. Okay, let's jump in, Rabih. What's up with all this drama?
Dude, Matt, the drama is here. I've been probably saying for a month that, hey, once the data starts getting released, there's going to be some swings. The market is going to move erratically and we'll start scratching our heads for a bit. We only got 2 data points. And this thing, it's a mess. It's all over the place. And we still haven't gotten the main important data. But we got 2 important data points related to unemployment, but they are related to September. We got the unemployment rate, and the unemployment rate for September ticked up to 4.4%. This is the highest it's been since COVID. So we've always hovered at the 4.1, 4.2, 4.3 range, and we're, cycling through these, and we got a sticker. It's a 4.4, which on one hand, what does this tell the market? This tells the market that the labor market is slowing down, and because unemployment rate is inching up, the economy will slow down, which will prompt the Federal Reserve to cut interest rates. So good news for
good news,
markets. Yep. Then we got other data which talked about the non-farm payrolls, and they are healthy. And the economy, just to give you some reference, in May, we added 19,000 jobs to the economy, which is, a rounding error is a 0. In June, we lost 13,000 jobs in the economy, which is a rounding error also at 0. In July, we only made 72,000 jobs, which is okay, different than 0, but not big enough. And then in August, we lost 4,000 jobs, which is definitely 0. So the economy didn't grow for 4 months, right? From a jobs perspective. And then in September, we added 119,000 jobs. So we've got higher unemployment, but we've also got an economy that kind of changed trend and went from flat to increasing jobs. So the market kind of got really mixed feelings. And if you remember last week, we were talking about, or the week before, we were talking about the Fed funds rate futures, which is the market expectation for the Federal Reserve's decision, whether they're going to cut interest rates in December or not. And we said it's 50-50. They are completely confused. They do not know where it's going to be going. And with this data, actually, to show you the magnitude of the madness that's happening, is that yesterday, November 20th, on the Thursday, the probability of a no cut was 60%, 40% for a cut.
Wow.
But today, the probability of a cut is 70%, and the probability of a no cut is 30%. Not only did it complete switch symmetrical, and with that comes a lot of volatility in the market. Yesterday, I would say since the beginning of October till now, we are in the kind of flattish area. Nothing, if you zoom out and you really do not focus on the noise, nothing much is happening in equities. But if you follow it day by day, you'll feel like we're in the middle of a crash or a recession, or it is, the magnitudes are large, the swings are large, which is nothing but noise. Yesterday, it's opened 2% up. And they opened 2% up because NVIDIA had its earning, blew everyone out of the water. Incredible company. But then midday, the Federal Reserve says, well, we're not receiving data as fast as we could. And now, the Bureau of Labor Statistics said that they're not going to release October CPI. They're just going to forget about it and move on to November. And the Federal Reserve is saying, hey, we do not have data, so we're not sure whether we're going to cut in December because we do not have data. This is why, there was a 60% probability of no cut. And the market is losing it. So we opened at 2% positive and we closed the day as a 2% negative. So there was a 4% move.
It's a big
just
swing.
In one day, which is usually one of those extreme days. It's not, it's not April 2025, but it's still a very bad day. Like you go online and definitely there's more traffic on websites and clicking it. It's like, what's going on?
Yeah.
And it's just a matter of we're trying to absorb this information. The Federal Reserve is uncertain, just like market participants are. The market is trying its best to price to collect into the price all the information that's available, but we're getting nowhere. And there is drama, but on the large scheme of things, it's not that important. Do you have thoughts on all this mess?
Yeah, I would just say if you're watching it every day, don't do it. Just listen to us. Just listen to 2 cents and we'll tell you that it's no big deal.
I know. I'd wish
We'll
I could just close my computer for a week because I'll come back and nothing would have changed. But I do this for a living, so I'm supposed to suffer. You guys don't have to.
Yeah, you don't have to suffer through this.
Yep.
No, I mean, I don't think I have. I think one thing that I'm thinking about is maybe not looking forward to 2026 in the sense of all of this noise, because now we are adding another layer of this, which is going to be some pretty important midterm elections. And I think when you add in that, it makes it even noisier. And so I'm not saying I'm not looking forward to the year as a whole. I'm always looking forward to the future.
Is it because of a certain team might win the Super Bowl? That's why you're looking
we're not ready, Rabih.
Okay.
I'm going to let this weekend will tell me a lot of what's going to happen with my Eagles. I'm not ready. I'm not prepared. This might be the turning point week. I don't know. Last year it was against the Ravens, and I was like, I came on the show and I was ready to call it. I'm getting close. I'm getting very, very close to calling it, to making my prediction, but we're not there yet. I'm going to wait till this week and maybe next week. We'll see. We'll tease to next week. But no, I just think that the midterm elections make things a little bit, or a lot of bit noisy, and I'm not looking forward to that.
100%. I think also the choice of who the next federal chair of the Federal Reserve is going to be very important, especially now. If the Fed says, hey, we're not cutting in December, and let's assume that scenario pans out, then it's going to be even more hyped up. Who's going to be the new chair and how aligned are they with the administration and how many cuts we're going to have. And you could expect a rally that feels de-anchored just because people are high on the idea of low interest rates, and stocks love low interest rates.
Yeah.
Right?
Yeah. You said as of today, we're back to a 70% chance of a cut?
Yes.
Got it.
But
that
it
could
was
change by
40% yesterday.
Yeah.
So the amount of moves, the moves are usually, this amount of moves happen over a course of a week. We're seeing them in a day. which means we need to calm down, people. Like,
Yes.
take a breath.
Yeah.
Nothing is really breaking in the world to prompt and justify moves like this. These moves are just happening based on people losing their minds, which is
Yeah.
really when the market is being irrational.
Yeah, it's too calm, so let's make up some drama. How about that? That's kind of what it
100%.
is.
So, talking about drama.
Speaking of drama,
Speaking of drama,
Rabih, what are your thoughts on Secret Lives of Mormon Wives? No, I'm just kidding. Are you Team Whitney? I'm only getting this from my team. I don't watch any of this stuff, but
I think we need to loop people in on this. We were having lunch on Wednesday, and usually we discuss sports, but this week we discussed that.
Pop culture this week.
Pop culture.
Which was the drama apparently happening with Dancing with the Stars, and we had some internal battles of, are you Team Whitney or are you not? And I don't know, but I just know that split evenly among the team.
I do have drama, but it's not about Dancing with the Stars. It is about more investments related stuff. And it's about
Let's go
crypto.
to that drama.
It's about crypto. It's about Bitcoin. It's about MicroStrategy, which later on became strategy, right?
Yep.
So let me just give you some background information to understand where all of this is coming from. We've got a company that is incredibly well hyped in the crypto world called MicroStrategy. I'm just going to keep calling it MicroStrategy, although they just changed their name. And what this company was just a software company. Think Adobe, think Oracle, think Salesforce. They were just a software company that does analytics, and they were not competing as well. So their CEO and CFO came up with a brilliant idea of trying to make their company look much better on paper. So just like any company has a treasury department, or if you're a much smaller company, we can think of a dental practice, you have a big fat checking account where you're hopefully keeping at least like a year of expenses in it, right? For liquidity management. In larger big companies, this is called the treasury department of companies. And they handle all the incoming, outgoing transactions as well as the cash reserves. So MicroStrategy's CEO was like, we think inflation is gonna come after us, and for that reason, we're gonna be changing all of our treasury, all of the cash that's sitting in our treasury accounts, and we're gonna be putting them into Bitcoin. And this computer software company started buying Bitcoin, and the market loved it because now because a stock price is kind of a leverage, because every single company is made out of equity and fixed income. So when you add Bitcoin to the assets, now as a stockholder, it's like you're buying options or you're leveraging up your Bitcoin exposure. So all these crypto bros just loved MicroStrategy because it's giving them an opportunity to amplify their exposure to Bitcoin. So at that point, MicroStrategy discovers like, oh, wow. So our stock price, just because we added Bitcoin instead of our cash reserves in our company, our stock price exploded. And it was like going up 100% a year for the last 2 years. And
not based on fundamentals, by the way.
Not based on fundamentals. And actually, if you take the total value of the Bitcoin and you compare it to the total value of the company was much higher than the value of the Bitcoin. So the market was kind of giving them a premium and rewarding them with a premium above the value of the Bitcoins that they hold, just because they are giving leverage exposure. And as everything that happens in the market, we double down on it to a point where it becomes unhealthy. This company started raising debt to buy Bitcoin, not to service its, software business. It's still struggling, the software business. I just pulled up all their financial data yesterday night, and their operating income is still down. The net income is still down. Like, if you exclude the Bitcoin impact from the business is failing and it shows that the business is failing.
So like the GameStop of 2025, basically?
Kind of. So what's been happening is that for the last, year or so, MicroStrategy has been borrowing money, issuing shares, preferred shares, etc., trying to raise money on exchanges outside the US, all to use that money that was raised to buy more Bitcoin and add it on their balance sheet. And as the price of Bitcoin goes up, the value of this company goes even more. They raise more money and they buy more Bitcoin, and the cycle continues.
This is Michael Saylor, right? He's like the biggest...
This is Michael Saylor.
Yeah.
So all of this has been happening until we go back to now seeing the Bitcoin prices starting to fall. So all of this was going great until the price of Bitcoin starts going down because the company had a leverage exposure. Actually, Matt, I've got some year-to-date data for you. Remember, like back in I would say beginning of October, we were looking at like the price of different assets and we said, oh, gold is blowing everyone out of the water. But then year to date, we've got Bitcoin with like 45% for the year, which was like great news. Like after gold, we had Bitcoin making 45% for the year. Well, now year to date, Bitcoin's performance is down 9.8%.
For the
So
year.
you were up 45% for the year. And now a couple weeks later, you're down 9.8%. And if
swing.
you look at MicroStrategy, it is up, it's down 40% for the year. Back in July, it was up 55% for the year. And you're talking about a large drawdown to the
90-point swing.
To the extent that Bitcoin from its high right now is down 32%, and MicroStrategy from its high is down 61%. So all of that is, good. The market yesterday, there was forced because MicroStrategy is going down and Bitcoin is going down. The value of the Bitcoins were much less than the value of the value of the company started being much less than the value of the Bitcoin. There was a forced selling, liquidity pressure type of panic in the crypto market this week, and we do not think it's going to be ending because as MicroStrategy's at market value starts dropping, it's not going to be considered part of like the largest 500 companies in the US. And there is going to be a risk at the end of this year that it's going to be taken out of delisted from the index in a sense. AKA, if you buy the S&P 500, you do not have exposure to it anymore. And when they do so, and it's removed from the ETFs or the mutual funds that track the S&P 500, all the large players in the world, you're talking Vanguard, State Street, iShares, blah, 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 those people will just rebalance their ETFs and mutual funds, which hold trillions of dollars, and dump more MicroStrategy shares. Which now we were talking about a cycle of raising money and keep going up as Bitcoin goes up. Now we completely shifted the narrative. And as Bitcoin goes down, you have to sell more to cover for the sales.
This is the problem with leveraging.
And you sell 100%. And Bitcoin has dropped from a high of 112 to 87 last time I checked it.
I think it's 85 now.
Now 85. It could drop even below. The more Bitcoin drops, the more on paper MicroStrategy has losses. The value of the company is lower, but they've got all this debt that they have to pay back regardless, which, is a really bad position to be in. So if Bitcoin rebounds, that crisis could be averted. But if it doesn't, it'll take the whole ship called MicroStrategy down with it. So it is scary. Hopefully this is contained within MicroStrategy because we don't know much of other companies that have exposure to crypto on their balance sheet. Like Tesla used to own Bitcoin, but then they sold them because it's like, we need the money to service the actual business. We care about making the cars. MicroStrategy is like, we don't care about the software business. It's all about the crypto right now. This is talking now is too late, but you shouldn't have had all your exposure in MicroStrategy. And just like you should not have all your exposure in Bitcoin, that thing just is dropping 30% in 2 weeks. So the volatility is there, and that is adding up to the confusion that's happening in equity markets. And there is all this drama, but nothing major is breaking. You've got one asset dropping in price. You've got a Federal Reserve that's sending mixed messages just because they don't have the data. Together, along with, whatever is happening in the world, is making the market overreact.
Yeah. Well, and there's a lesson here we talk about over and over and over again, multiple lessons here, which is number one, not betting too much on any one company or asset class. I'll put Bitcoin in the category of like a company type thing, even though obviously it's not. So being thoughtful and careful with that. But then again, this idea of just Bitcoin or investing in I wouldn't say investing, buying MicroStrategies, you're seeing the consequences of something that is pure speculation, which is what Bitcoin is, and how rapidly things can change with things like that when they're basically like beholden to momentum, either on the upside or downside. But as you're highlighting, Rabih, when you're thinking about things like Bitcoin, we've talked about this over and over and over again. There is no, I'm going to piss some people off, Rabih. I'm a little nervous.
Go ahead. Why
Am
not?
I going to make people mad?
This is everyone's early Thanksgiving dinner. Let's go.
Yeah, I'm probably going to make some people mad, but there is no, it's been proven, I think, at this point that Bitcoin is pure speculation. There is no use case for Bitcoin that has been that's stuck. There's a lot of hypotheticals, but there's not a use case for it of outside of, again, speculation. So this is a perfect example of what you see. So I called it kind of like this MicroStrategy is the GameStop of 2025, because it's whenever you're riding that wave up and chasing the returns, short-term returns, just as assuredly as it went up, what's going to happen at some point with that momentum flipping. And just kind of like a cautionary tale of your behavior being a fundamental piece of, or probably the fundamental piece of your long-term returns, of how you treat things like this.
Yes, 100%. Especially in a market environment like now. Like the last couple of weeks, we've been hearing the word AI bubble a lot. But it's not like a bubble.
That
it's
has
like,
been everywhere.
It's a small, I'll call it a bubble, but it's a very small balloon somewhere. But you also got another small balloon that is in crypto, and we're just seeing it pop with Bitcoin and MicroStrategy. And there's probably somewhere else with commercial real estate. So instead of thinking as the whole economy as a big, big, big balloon, think of it's like chicken pox everywhere. It's like those aren't supposed to be here, but they're distributed. And every once in a while, something will pop. Hopefully, they do not all pop at the same time, because that would be equivalent to a big balloon popping.
Yeah.
I love how I brought chicken pox into yeah.
Somehow we went to chicken pox. I like
don't know
it.
how my brain works. I'm sorry.
That's awesome. Okay. Anything else that you would like to hit on that?
No, it's just noise, and we think the noise is going to be continuing. Like, this is my personal opinion, just because there will be more data released. And until we catch up and have all the data coming, and all data point that's being released is timely, the market is not going to go back to what it was pre-shutdown. And, you just have to swallow this noise spill until it's over.
Yeah. Yeah. Okay, that's good. It's good stuff, Rabih. Let's jump in, and this kind of segues. We talk about cautionary tales of bubbles and being careful with certain things. We're going to talk about another one, biting the dust. What does that mean? Rabih, you said that. What does that question mean?
No idea.
No idea. So we wanted to talk specific to dentistry. We're actually a little bit late on this story. This actually broke a couple months ago, but wanted to talk about this DSO in Colorado. Sun Health officially collapsed, and this was brought to our attention from, shout out Becky on our team. She sent us this. Again, this, I think, all officially kind of broke in September, but we thought it would be, again, this is obviously very pertinent to dentistry, and want to talk about kind of the bigger ramifications of this, or just things to be thinking about when it comes to your career. So I'll just hit this. So a Denver-based DSO, Sun Health, collapsed. It defaulted on over $8 million in loans. Basically left all the dental practices that were a part of it kind of just out to dry, and it created this massive mess. So this was founded by a guy named Eric Nuss. He's also now since filed for bankruptcy. He's facing multiple lawsuits. He founded this in 2018, and at one point had up to 10 practices, but it unraveled pretty quickly. I mean, within a matter of within 6 or 7 years. Here was the telltale sign, Rabih. You tell me if this is a bad sign. Where people started to notice that this company wasn't doing well, is because they stopped getting paid.
Oh,
yeah, I think that might be the first.
Too late.
The first sign.
It's too late.
They stopped getting paid. Their 401k stopped obviously being funded. All sorts of issues. It just kind of snowballed from there, and they've since gone bankrupt. A former staff member came out and provided a spreadsheet to investigators, and there was some questionable things that our guy Eric Nuss was spending on, including $11,000 on sporting goods stores and $15,000 at gun shops is what they found. So some questionable management with the company money from this guy. So this is truly not meant to like make fun. This has impacted a ton of people in these practices, staff, doctors, patients, families. It's more of, again, I think the reason we wanted to bring it up is a cautionary tale, and just a reminder to be so careful when it comes to DSOs and corporate dentistry. I think the good news is, Rabih, that dentists are becoming much more thoughtful about this, but this is a drop in the bucket right here. This is a 10 location DSO in Denver. There are far bigger DSOs now that are following suit, we will say. I'm not going to name any specific names at this point, but a lot of you know who these groups are. There's a couple in particular that it has already come out that there's some massive legal issues and concerns with practices far bigger than the Sun Health group. So again, it's just something to be aware of, something to be really thoughtful about. If you're out there being courted by some of these groups, you got to be really, really careful. This is a really, really bad example of like, obviously really far into the spectrum of this guy allegedly is just a crook, straight up crook. I'm not saying that this means every DSO is like that, but it's just, again, be careful out there. Rabih, what are your thoughts on this?
Yeah, and this is related not just to DSOs. This is related to private markets as a whole. I want you to look at this from this perspective with me. We say the market has learned from its mistake. Like, we're not going to have another .com bubble because the market has learned from its mistake. We're not going to have another 2008 because the market learned from its mistake. We're not going to have a flash crash of 2018 with volatility. Do we really learn of our mistakes, or do we change the system to prevent that mistake from happening again? So in the public markets, you've got .com, you've got 2008, etc. Then we've got regulation like the Sarbanes-Oxley Act, and think of Enron not happening again. Like, why Enron didn't actually happen again? Sarbanes-Oxley Act, or the Basel III Accord for bank liquidity and regulation and health of the financial system. Think of like currency sweeps that the Federal Reserve did in COVID that they learned about in 2008. All of these are rules that we learned after the fact, and it's like, to prevent it from happening, we're going to create new rules, new regulations, just to prevent the mistake from being repeated. So the human nature does not learn from its mistake, but the system could implement rules and regulations that prevent the mistake from happening again. But all of this that I'm talking about is in public markets. So in private markets, you will have a .com style bubble in the .com, in the private markets, especially in those, San Francisco AI-based private equity deals, right?
Yeah.
You will have something like Enron, where it's corruption on the balance sheet, that there's no really real money being made, it's being wasted in a DSO, simply because there aren't regulations there. So yes, private markets are going to expose you to properly higher returns if it worked out, because they have a different type of leverage and management. But also, they do not have the protection or the scar tissue that the public markets have had, because they do not have the regulation that prevents that scar tissue from being there. And this is a risk that you should be aware of. If I tell you, hey, do you want to invest in the S&P 500, knowing that we can guarantee that an Enron-like situation, a .com bubble, is going to happen again, and 2008, exactly the same. They say history doesn't repeat itself, but it rhymes. No, I'm telling you here, it's going to repeat itself. Would you still invest? You'd say, no, I'd rather have these regulations in place. Well, this is what a private market deal is offering. I'm not saying don't do it, but just know how different the risks are.
Yeah, that's such a good example, Rabih, and such a good distinction. Because I'd say, yeah, humans don't change. Like, we'll always be making kind of the same mistakes that are always based in either greed or fear, and then the system will adjust, right? But so I think it's a really good point of the inherent risks of these private deals, just in general, outside the public markets, and the extra risk there. And to your point, in theory, when there's inherent risk that is there, on the other side of that needs to be inherent theoretical upside, or what we'd call like a premium, a risk premium. So there is that there in theory, right?
Not all risks, the saying of more risk, more return applies, but only for pure systematic risks. If you're getting idiosyncratic risk, corruption risk, logistics risk, etc., you're not going to get more return just because it's like saying, oh, I'm not going to put my seatbelt on, that I'm taking a risk, so I'm going to get more return. No, not all risks are the same. Only The systematic risks are the ones that you get rewarded for on taking on, like a market risk, exposure risk. But company-specific risk, you're not going to get rewarded for that.
Okay. I'm so glad that we went down this road, because I do think a lot of times dentists do think this of like, oh, well, got to take risks to get the returns. It's like, but you're highlighting that is a misunderstanding of the concept.
Yeah, not all risks are the same. You have to refine it, clear it out, purify it. And once that risk is an appropriate type of risk, at that point, you can say more risk means more return.
Got it. Yeah, that's a good point. Well, so I guess the main point here is just, again, be cautious, be careful. There's other big groups out there that are going, much bigger groups that are going through similar situations. This one I'm actually going to name because it's already out there. This isn't like a secret. But because this was in May, this was even earlier, but it goes along the same lines. So specialty dental brands, this is a big one. This is huge. People already know this. This isn't like private knowledge. In May of 25, they have so their former owner, Leon Capital, they're in a massive lawsuit now against Leon Capital for, there was allegedly, basically a huge firm made an investment and is suing them now because allegedly the company, they're alleging that the company was built on false financials, that they basically just made up a lot of their data. And so it's a bit of a mess right now. And this is a personal, very, very personal to me, in the sense of I know personally quite a few people involved in this from the dentist side. And so again, it's just this is even more of a cautionary tale of just being careful out there moving forward. A lot of these things are now coming to fruition around the risks that maybe a lot of dentists didn't often think about, and the false promises a lot of these groups made. And so I'm really glad, Rabih, that you made that distinction to kind of wrap up this segment, to reiterate that it is not as simple as saying more risk equals more return. That you can't always apply that to all these situations. Sometimes it's just like, no, you're just not wearing a seatbelt, and if you get in a crash, you're going to die. Like that's a very asymmetrical risk you're taking.
100%.
Okay, love it. Any final words on this one for dentists to be careful out there with the DSO space?
Just do proper due diligence, or ask a financial advisor to help you do proper due diligence.
Yeah.
Shameless plug,
Yeah, try to remove emotions as much as you possibly can, I think, is a huge piece of this as well. Okay, last thing here, last part of this is how much can you contribute to retirement accounts in 2026? This is the exciting world of 401ks and IRAs, everyone, but they've announced officially what you can contribute. So we thought we would just add this here at the end, and it's crazy, Rabih, what they've done. The additions the increases they've made, life changing. I say
this is more dramatic than the first segment,
I say this,
right?
Yeah, I say that very, very sarcastically. Okay, so we'll just go through this 401k contribution. As a reminder, there's two sides of a 401k contribution. There's the employee deferral and then the employer contribution. So as a practice owner, if you're a practice owner, you have both sides of that equation. If you are an associate, you are just obviously the employee. So as an employee contribution in 2026, you can now do $24,500. So Rabih, extra $500 or extra $1,000, life changing. No, $24,500 for the employee contribution to a 401k. If you are 50 years or older, there is a catch-up contribution that is $8,000. There's a little wrinkle here that they've actually changed, a couple of things, but there's a little wrinkle that with the Secure Act 2.0 starting in 2026, that can now no longer be a pre-tax deferral on the catch-up piece. It has to be Roth.
Okay.
So kind of an interesting little wrinkle there. So total for if you're 50 years or older for a contribution for employee is $32,500. That's a big deal. Like overall, just that's a big number for if you're 50 or older. And we see this a lot of times with dentists, like the back end of your career, you're able to really load up your retirement accounts. Let's say you're going to work for another 10 years and you're able to put away just in the 401k, $32,500, let's say plus profit sharing. If you're doing that, it can start to really backload your investments there. There's also another wrinkle here. that there's even an additional contribution, additional catch up if you're between the ages of 60 and 63. Don't ask me why, Rabih, that they did this, but there's an additional catch up, or I'll say this, the catch up increases to 11,250. So if you're at that back end of your career there. For IRAs, traditional and Roth, same contribution, or same limit, which is now 7,500. Again, catch-up contribution if you're 50 and older now moves to $1,100 extra. So the total you can put into either a Roth or a traditional if you're over the age of 50 or older is 8,600. Health savings accounts for 2026, HSA self-only coverage is 4,400. Family coverage 8,750. And then the last one we'll say here, simple IRAs went to 17,500. And then I'm not sure, it actually goes to 18,100 for those eligible under Secure Act. I actually don't know what that means off the top of my head, but there you have it, Rabih. There's the increases to retirement plans. Any thoughts?
It feels insignificant. It's just like, yeah, an extra $500 a year, right? But if you compound that for 30 years at 10%, that is around 82K. So that's probably one more. If you spend 82K per person a year, that's an extra year of retirement tax-free.
There you go.
So yeah, it's tangential, but if now you do not care about an extra year, but probably when you're burnt out in your late 50s, you would love to have that extra year of early retirement. So just take that into consideration.
Yeah, for sure. We're angry internally. We pass these around internally, and we think a couple of the guys get pretty hot about it, especially Jake and Taylor. Shout out to those guys. And I get what they're saying. They're like, why can't we just have these be divisible by 12?
Oh, yeah.
Every time, just make it divisible by 12. So it makes it easier for everyone. Because, we're going through making sure people are up, increasing their drafts and all that to line up. And we're like, can we just make this easier and make it divisible by 12? So I'm going to write a letter, or maybe they'll listen to this and they'll fix it. So,
hopefully.
Rabih, anything else you want to cover? Any other words of wisdom for the people?
No, stay tuned for next episodes.
For coming up, Thanksgiving episode teaser. Okay, well, Rabih, thanks as always for being here. If you are still listening, as always, you're one of the cool ones. If you want to talk to us, we would love to talk to you. We dentist advisors talk to hundreds of dentists every single year and help them navigate their complex money situations, investing, debt, cash flow, whatever it may be. If you're out there, if you're one of those dentists out there thinking, man, I don't know where my money's going, you are not alone. We hear this all the time and we're here to help. So go to dentistadvisors.com. You can click on the yellow book free consultation button, and we would love to talk to you as we wrap up the year. It's a good time to be having these conversations. So we'd love to chat. But again, for now, Rabih, thanks for being here. Everyone, thanks for listening. That was our 2 cents. Till next time, have a good weekend. Bye-bye.